Hi, welcome back. Remember we were talking about the role of capital gains and the capital gains mechanism to fuel growth in the capital stock so that the economy is able to reach this point and go a little beyond so that the growth funding mechanism, this delta that was the exogenous speculative increase in savings, is able to kick in and drive you towards the new speculative equilibrium. Now, we said that this capital gains mechanism worked as some sort of a self-fulfilling investment boom, right? People think that the price of capital in the future is going to be high, so they find it really profitable to invest in capital now. So they buy tons of capital, and this price of capital keeps rising in the future. So the rising capital gains compensate for the diminishing returns of capital. So they compensate for the fact that when the capital increases, the MPK decreases. So if this future path of prices goes up by enough, it will be able to overpower this MPK, and the investment boom will be self-fulfilling in the sense that expectations about future prices will actually lead the economy towards this new regime. And very importantly, this mechanism means that fluctuations in the economy, increases in capital, may be driven by how asset prices fluctuate over time. So these feeding mechanism between rising stock market prices and increases in investment, it is really the key of this paper. And by interacting with this growth funding mechanism, it really gives you a good intuition on how we can see periods in which there is a lot of speculative growth. Now, the way this works is that imagine that you're going from the normal capital level to the speculative capital level. So at the beginning, you're at the steady state, and capital prices are the same as 1. So basically at the beginning, this is 1, and this 1 cancels out with this 1, so we are in the normal case. Now, if people believe that the price of capital is going to be really high in the future, they're going to start investing in capital, so the price of capital is going to go up. And if it goes up by a lot, then it is going to overpower the decrease in the MPK if the capital gains are strong enough. And then beyond this level, the delta kicks in. So, even though the price of capital is going to deflate over this period of time, it doesn't really matter because we're going to reach the new equilibrium up here. So if we're moving from here to here, going up this way, the prices of capital are going to increase, and then beyond this point, we're already setting up to reach this equilibrium. So the prices of capital are going to decrease until they reach the equilibrium price of capital, which is 1 again. And if we're going back from the speculative equilibrium to the normal one, then which is very pessimistic about the price of capital, and this ends up happening so that the price of capital goes down until we reach this level. Savings decrease by a lot beyond this K0, and at this point we see the capital price return to 1. The way they're going to make this actually happen is using some adjustment cost. So it costs you, getting into investment is going to cost you a little bit, and this generates a friction that drives up the price of capital. So this is just a way to get the MPK to differ from the interest rate when the price of capital in the future is different from the price of capital now. So let's go back to this example. We have, our normal economy. It is in the steady state, so price of capital is equal to 1, the interest rate is equal to the MPK. Since the price of capital is low, it's normal, the MPK is going to be really high, and also the interest rate is going to be high. And it happens to be the case that the interest rate is so high that we are above the growth rate of the economy. Remember that this is what was giving us that growth. Now, if you go back to the OLG model with consumption and capital, remember this was the zone of dynamic efficiency, and this was dynamic inefficiency. So here you could increase consumption by reducing the level of investment. Now, since capital is low, we're going to be here, and it's going to be the case that R is greater than the growth rate of the economy. So we are in the zone of dynamic efficiency. So things are normal here. But imagine that we have a shock to expectations, so we suddenly think that the price of capital is going to increase by a lot. Well, the price of capital actually increases, and we invest a lot. The price of capital keeps going up, so we keep investing until we reach this K0 point, at which point delta is going to kick in. The growth funding mechanism is going to kick in. We're going to move to this other part of the law of motion, and we're going to go to the new speculative level of capital. So capital prices are going to go down until we reach again the steady state level in which the price of capital is equal to 1 and the interest rate is equal to the MPK. Now think about this. Here the capital level is really high, so the MPK is going to be low. That means that the interest rate is also going to be low. And in fact, it's going to be so low that it's going to go below the growth rate of the economy. That means that we have moved from this normal point to a capital stock level that is in the dynamically inefficient area. Because at this point, the interest rate is so low that it's below the growth rate of the economy. Now, the authors are going to show that, in this dynamically inefficient area, if we reach this speculative equilibrium, a lot of weird things can happen. We can have bubbles appear and that sort of thing. But this is all I wanted to cover with the video, so thanks for watching.